Welcome to Subramani. The greater the number of new Zerodha investors or Robinhood investors, as they're called, there seems to be a feeling that buy and hold is dead. Only the active investors will make money. I completely agree. The active investors will make a lot of money for their brokers, and that's for sure. If you look at the quarterly results of ICICI Securities or Zerodha or India Infoline, you realize that there is fantastic money to be made by opening new accounts and getting people to trade. In this market, is it possible to get people to invest for the long run? Seems to be impossible. Are fund managers able to do it? No. In fact, fund managers who talk to me privately admit that I am better off because I don't have somebody breathing over my portfolio and looking at it on an hourly basis saying how much is the NAV, right? So I can go wrong for 5 years at a time and still not have to worry, whereas a fund manager going wrong for 2 years would be ripped apart. Going wrong for 2 quarters will be criticized, be called an idiot. They would say he's over the hill, it's time he retired, right? All those things. Now look at an investor or an investment oriented fund manager. He has got a choice of buying some shares at a PE of 6 and some shares at a PE of 60. The shares at a PE of 60 look smart because after a month the PE changes from 60 to 70, whereas the PE from 6 has gone to 5.8 because the prices have fallen. So now what do? Do you buy more of that 60 and look smart in the short run, or are you willing to look stupid in the short run to look smart in the long run? I do not know, but I have a portfolio which there are some shares which go as far back as 40 years, to be very precise 41 years, right? Then there are some which go back as 43 years. I have gained. Now if I draw a chart, there would be big chunks of time when it has done nothing. HUL, Reliance, Colgate, all of them can be accused of doing nothing for long periods of time. May not be applicable to Nestle, Siemens and Cummins, but yeah, Siemens also has done very badly over periods of time. If you take over 30 years, it may have given a index beating return, but if you take 40 years with dividend, it is definitely given an index beating return. But there would be chunks of 5 years, and so somebody will come and tell you, if you had sold and bought it back, you would have got a better deal, right? Hindsight is 20/20, perfect. Everybody knows what should have been done. There are times when I have done it and I have benefited. Let's say I have 10,000 shares of a particular company. If I were to trade in 2,000 shares regularly, you could make some money, but I would have perhaps made some money in those 2,000 shares, but I would have made good money, reasonably good money, even though those 8,000 shares. So it doesn't really matter. This playing around with 2,000 shares, I still call it playing around, would have improved my return by maybe 1% in a year, which is not bad at all, considering that over 10-15 years that makes a significant difference. So to say buy and hold is dead seems to be wrong, but by doing some smart trading, you could improve your returns, but the tremendous amount of discipline that is needed for doing that is not something which can be ignored. You have to decide that, okay, I've got 3,000 shares of this company, I will trade only in 500, or I will trade only in multiples of 250. So I will sell 250. If the price goes up further, I'll sell another 250, and there I will stop, because after that I may not be able to buy it back, and after that maybe a year or two later, if the price falls, I'll buy, or that's gone. So my overall holding has gone down from 3,000 to 2,500, but I'm happy with that, right? So that is one thing which I see people do. But fund managers are nothing great. If you look at fund manager churn in their portfolios, even in value investing portfolios, the churn is pretty high. So I do not know whether buy and hold is dead and only smart trading is there. But from the looks of it, the younger investors or the newer investors who come into the market just cannot stop itching. So they buy and sell. And one more thing which has happened in the market is the role of media, which considers one day as short term and maybe half an hour as short term and one day as long term. and the fact that all the broking houses have a रिलेशनशिप मैनेजर हु विल कॉल यू एंड से सर आपने तो 970 में लार्सन एंड टुब्रो खरीदा, 1040 हो गया, आप प्रॉफिट बुक कर लो, विच मीन्स 40-50 रुपीज़ 70 रुपीज़ ऑन 1000 रुपीज़ शेयर, which is almost nothing, is considered to be fantastic over a period of time. Now imagine what happens, you keep churning, the profit looks good, but understand that you are taking the risk and the brokerage house is earning the profit because they're getting the brokerage. So there are analysis done. I've analyzed 2 portfolios with PMS, and that PMS was being done by brokers, of course, where the brokerage paid would have been at least equal to the profit that this person made, and that's not too bad because the client also feels that's okay. He has earned me so much now after the brokerage, so that is good. Now if that is the expectation, then yes, in a bull market, good chance that trading will look smarter than buy and hold. So why should you think that if it works in a bull market it won't work in a bear market? Simply because people don't like the idea of going short, and that going short is far more difficult and risky, and it can wipe you out. Well, in comes the great hero F&O. So then people get into F&O and they think that they will make money and they get wiped out. Very quickly you can get wiped out in F&O if you don't understand what you're doing. So let me look at what I had written about buy and hold some time back. I also think from looking at portfolios even of good fund managers, there is not much evidence that they do a buy and hold and therefore they are doing well. There is not enough evidence. It takes tremendous amount of guts of big professional fund managers to look like an idiot in the short run. Only the real brave ones can stick around, because the CEOs of smaller companies or CEOs of other companies will say, look, that guy is now getting old, he cannot do it, he's bought this, and I get analysis from other fund managers about the bigger fund managers saying our funds have actually done better than that fund over a 5-year period or over a 3-year period. Perfectly all right. Over a 7-year period, if it is done badly, they'll keep quiet about it, right? So to me, I don't really know whether it works. I can tell you what works for me. I have held for very long periods of time, it has worked for me. But my starting point is so low. For example, my Procter & Gamble is at a cost which is less than 10 rupees. So if the price today is 10,000 rupees, I can afford to sit out bad performance over long periods. If the price falls to 7,000 also, my IRR won't fall too much, right? And I will continue to get my dividends. So for older investors who have earned money, there is belief that it will work. It may not work in the future. One more possibility is companies have a shorter lifespan visibility. Am I sure that 10 years later this company will be there? I may not be sure. So why will I take a 10-year view? I find CEOs who don't take a 10-year view. They are here, they've taken a view that they've joined. There are people who have joined to increase AUM. There are companies where CEOs have joined to increase the market share. So if the CEO longevity is not there, if a CEO has been there for 25 years, you can think, or a fund manager has been there for 20 years or 25 years, you think he can take a long-term view. If a fund manager himself changes jobs every 3 years or 5 years, chances are you don't trust that he will be taking a long-term view on the portfolio, right? Also, it's wrong to look at the performance of fund managers over the short term and say, oh, he has not done well and I would do well. That's not true. Very few investors pitch themselves against the fund manager and compare with him on a regular basis. Scoring one-off success is very different than scoring a success regularly on a portfolio with a written down mandate, which means you will stick to the composition of the fund and all that. Individuals don't do that. So we look at fund manager performance and think that we can outperform. We don't know whether we can outperform unless we subject ourselves to the same rigor and to audit, right? So if I'm not subject to audit, I can tell you whatever I want because I'm just not subject to audit. The cost of trading, which means the brokerage that you pay, in case you buy research reports, the fact that you pay for it, the capital gains tax that you pay for it, the GST that you pay for it, right? All those things really hurt in a trade. Whereas in an investing, it can stay for a longer period. Now, dividends used to be taxed at 18%, 20%. Now dividends are likely to be taxed at your rate, so which could be 35-40% depending on the level at which you're paying tax. That could be another reason why you might just be better off with a low cost index fund and hoping to sell after 10 years or 15 years, because somebody else is doing the trading and you are getting the benefit of holding for a long period of time. So being in a dividend option in the long run, maybe 15-20 years, makes sense, because at that stage maybe capital gains will go back to zero. Right now it is there at 10%. So a lot of combinations that you need to do, and a portion of your portfolio can be in buy and hold, a portion of your portfolio can be in speculation, a portfolio can be delivery based speculation, right? So delivery based trading. So a combination will work. To say one style is dead and other style will work is wrong. To say what works in the bull market will not work in the bear market is wrong. To say what will work in the bear market will not work in the bull market is also wrong. To think that fund managers have the discipline to stick around with the portfolios is wrong, because some trustee will say नया कुछ बताओ, ये तो ठीक है आपका पुराना कहानी है, but a पुराना कहानी may be working well, but fund managers are under pressure to do something new. To sit in the office and not do something is not going to be very easy, because quarter on quarter, year on year, or month on month you have to show something, and showing something means some trading activity. So buy and hold may not always work, and buy and hold will be very difficult to do for fund managers too, because everybody is looking at their portfolio and saying, "Arey, he is doing nothing about this. The price is going up, he is not selling. The price is coming down, he is not averaging." I mean, if you do it, you are in trouble. You don't do it, you are in trouble, right? Damned if you do, damned if you don't. So with all this background, what will remain as buy and hold and how much you will trade smartly, very difficult to say. I don't think buy and hold is dead. Buy and hold has worked for me. 90% of my portfolio is buy and hold. I hold it for pretty long time. Shares like Equitas, I have bought at 40, I bought at 90, I've sold at 110, or I have sold at 120. I've done all kinds of things. I've traded in it, I've speculated in it, I've held for a long time. So sometimes this works, sometimes the other thing works. To say one style is dead because new people are not buying and holding for a long period of time is wrong. So some portion of your portfolio will work in the long run as buy and hold, and some will not. Thank you.